Joining us now, we've got Jim Thorne, Chief Market Strategist, Wellington Altus Private Wealth. Jim, thank you so much for joining us this morning. All right, let's talk a little bit about the Fed. As expected, they left the rate between 4.25%, 4.5%, but obviously a lot of the focus for this most recent meeting was going to be on the commentary afterwards. I'm curious to know your thoughts on what the Fed decided to do. I mean, again, expectations were largely for what it did, but what are your views?
I think the Fed should be at neutral right now, which is about 275. And we have to be honest with ourselves, knowing that Fed rate cuts take about 2 years to get into the economy. So the Fed is late. I think, Diane, if you and I were talking about this a year ago, we would be way out there on a limb. But now when you listen to the Q&A yesterday, I think that was much more informative. I think the Fed's reputation is being tainted here. I mean, I call it, does the Fed have Trump derangement syndrome, or TDS? Everything that he does in terms of his policies are interpreted with an extreme view of them being inflationary. And that's just not objective. It's not what the preeminent research institution and central banking in the world should do. We should demand better, and it should be better from the Federal Reserve. Completely disappointed with Jay Powell and the FOMC and the economists at the Fed.
So what if, to play devil's advocate here, for lack of a better way of expressing it, what if the Fed is right? I mean, we know that, Powell is consistently reiterating the messaging, data dependent, right? And the hard data doesn't necessarily show the weakness, especially when you think about the job market that maybe possibly to come. So what if the Fed is actually right to hold?
I disagree with your premise. I think the hard data is pointing to a significant deceleration in the economy. And if they would stop just anchoring off of the BLS data, which is antiquated, and if they would stop anchoring off of the University of Michigan inflation sentiment indicator or survey, which is highly skewed by the Democrats, you would sit there and say that inflation's not a problem, and that the labor market is balanced. So let's just say it's balanced. Then by definition, the Fed funds rate should be at our start, which is 275. So let's leave it at this. The Fed should have continued to normalize rates, and the communication strategy that they're giving us now would be suffice if the Fed funds rate was at 275, not at the effective Fed funds rate at 433 and quantitative tightening happening. What they are saying and what their actions are is a complete and total disconnect. So they're either an extreme level of incompetence at the Fed, or they've got Trump derangement syndrome. I mean, for investors, what we have to do is sit there and go, they're going to be late, obviously, and the rate cuts are going to go deeper than we think. So, you know what? They're going to go around the world and they're going to have all these community meetings and PowerPoint presentations, which is what they did after the global financial crisis. And nothing's changed. I am completely and totally disappointed with what the Fed is doing. And the fact of the matter is consensus is starting to come to see the world through my eyes.
Okay. So let me ask you this. Since you feel like the Fed is too late, and there are others who view it this way, is your expectation that we're going to see a bigger cut at the next meeting? And at the same time, I want to ask you then, how should investors position themselves if the Fed is too late?
Yeah, it's sort of, now I'm going to thread the needle for you and be completely, totally contradictory. I am not in the recession camp. And the reason why I say that is because the United States economy is a service-based economy. Somewhere between 70 to 80% of the economy is service-based. Diane, in my career, the only times we really have gone into a recession has been through a shock. 9/11, 2008, COVID. And, with imports only making up 14% of U.S. GDP and direct imports from China only making up 1.5%. Yes, a slowdown, of course. A recession, no. And remember, in 2022, We had 2 quarters of negative GDP growth, and it was not considered a recession. So I think we're going to get a slowing economy. I think the Fed is eventually going to be forced, embarrassingly, to start aggressively cutting rates. And if you look 5 to 6 quarters out, you have a slowing economy, liquidity is being pumped into the system. And last thing I would say to you, Diane, is
Mhm.
deflation is the risk. I anchor off of different countries. In Europe, the leading edge country I look at is Switzerland. Their inflation is zero, and the yield on their 2 year is now negative. That's what we're going into. And I can't believe the Fed doesn't have any economist that is willing to say that during the FOMC meeting, because that's just basic, fundamental, objective research.
Okay. Well, it does. Your views definitely seem to line up with President Trump and other voices that we've heard about viewing the Fed as being potentially too late. Jim, we'll have to leave our conversation there because we've got some breaking economic data coming up in a couple of minutes. That's our Jim Thorne, Chief Market Strategist, Wellington. Excuse me, that's Jim Thorne, Chief Market Strategist, Wellington Altus Private Wealth. Thank you, Jim.